despite increases in productivity, despite the fact that the economy is actually getting larger. This tends to drive people in search of the kind of extra profits that can be made, and that tends to form bubbles. All right, bubbles. Why are bubbles formed? Bubbles are formed in areas of the economy where there, in fact, are real opportunities for wealth to be made. These are legitimate areas of economic activity, but people head for them and move in on them because they think they can make an especially large return on their investment. The first big bubble, rather an amusing one, to develop in modern capitalism, developed in the Netherlands in the 17th century between 1620 and 1637, and the subject matter may seem rather peculiar. It was tulip bulbs. Now, tulip bulbs are in fact a legitimate area of investment. The Netherlands remains the cut flower capital of the world today, but over that period, tulip bulbs took off in terms of their value, and people began speculating in them. At the high point of this bubble, some rare tulip bulbs became as valuable and as pricey as a house. And then, of course, as always occurs in the case of a bubble, the bubble bursts. Speculators lose their money. People are driven into poverty. People are asking for answers. Okay, we move on to the second bubble, the most famous bubble in British history, which is called the South Sea Bubble. This was a bubble that was created in 1720 out of the legitimate need of the government of Britain to finance the national debt. So they decided to set up a monopoly company called the South Sea Company to deal with investments and trade with South America, a legitimate business interest. And the government from this company received a loan to help underwrite the national debt. Then the South Sea Company takes off. There are all kinds of other speculative ventures arise out of the South Sea Company, and all kinds of people get in on the action. Two mistresses of King George get involved, bishops get involved, poor people become wealthy overnight. It all takes off, goes up, and then, of course, it bursts. You have riots in the street. You have people who've been newly reduced to poverty. The government has to change course. A third bubble, a very famous bubble, concerns an individual in the United States by the name of Charles Ponzi. Now, this is guy, Charles Ponzi, who gets involved in the great speculative takeoff around land prices in Florida in the 1920s. This is a decade when people in the North now have the means, rapid transportation, to get down to Florida to spend their winters there. So this is a bubble that's developing across the state, on the Atlantic coast and on the Gulf Coast, to sell resort land to investors. Charles Ponzi goes one better up near Jacksonville. He actually claims that he is developing an area near a town, which it turns out never actually existed. You got people putting their money into this. The bubble bursts all across Florida, and Charles Ponzi gives his name to this kind of scheme. Now, a bubble that we remember that is more recent is the case of the dot-coms of the late 1990s. Now, this is interesting. Here you have a reorganization of the economy around new communications technology. That's legitimate. You got the rise of a whole series of companies, some of which are very wealthy, important, and we know who they are: Microsoft, Yahoo, Google. But there are other companies that you probably never heard of, like yada 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 .com, that came along and disappeared when this bubble burst. We were being told a lot of interesting things during the rise of the .com stocks. We were being told that there was a new economy in the world today, that boom and bust no longer existed, that you didn't have to worry if you were buying a stock if the price of the stock kept going up, but their company never declared a profit. There were no dividends being declared by the company. You didn't have to worry about that. In other words, things like price to earnings ratios didn't matter the way people had talked about this in the past. What people were clearly doing is just buying the stocks on the grounds that the stock value would continue to go up. They weren't trying to make an actual profit on the investment itself. The peak came early in 2000, and it came around the Super Bowl game being played that year when dot-com companies were buying ads to go on the Super Bowl that at a fabulous price, and those ads were more interesting than the game itself. A few weeks later, in March of 2005, the meltdown occurs on the NASDAQ, and you've got this tremendous crash in the value of the dot-com stocks from which the NASDAQ has never recovered. That index is still today at just a little bit less than half the total that it ran in March 2000 on the eve of the crash. That brings us to the proximate cause, if you like, of the crash in 2008, which of course was the subprime mortgage market in the United States. The housing bubble was developed over a period of years in the United States and led to the crash of 2008. Over the course of the past decade and more, there has been vast encouragement on the part of politicians to Americans to buy houses. Get in there and buy houses. The Bush administration pushed this dramatically. In fact, the Clinton administration before that did the same thing. They brought in a scheme in 1997 that allowed homeowners to write off the capital gains for a married couple on the first $500,000 of capital gains on a house they had bought, provided they had lived in that house for 2 of the previous 5 years. Mortgage interest deductibility had long existed for home buyers in the U.S. Here you have the Bush administration convinced that if you get more homeowners in the U.S., it'll attract people to the Republican Party. So you've got the Bush administration pushing people as house prices are going up to get into the market, pushing the financial institutions of the country to bring in mortgages with teaser rates to get people in at the beginning, and then later on the mortgage rates are going to go up. Interest-only mortgages, in other words, they're not even paying off any of the principal. The Bush administration received countless warnings from officials in the U.S. government that a bubble was in the process of being created. But they didn't care about that. This was part of a rising, if you like, American economy built around this bubble. People were borrowing money on the value of their houses, and the Bush administration ignored the warnings. Then, of course, the crash occurs, and the whole system starts to work in reverse. Because, of course, once the crash occurs and prices start to dive, people who are sitting with a mortgage, previously they thought of the mortgage as something they could bear because the price was going up and they could sell the house at a higher price. Once the price starts to go down, they're carrying a mortgage that may be bigger than the value they can get on the house. And then, of course, you have foreclosures. You've got people declaring bankruptcy. You have the foreclosure crisis. That spreads, and it spreads into the entire financial sector of the United States and begins to drag it down. And that's where I'm going to take up the discussion when we continue in segment 3 of this lecture and look at the longer term consequences of this crash of 2008.